Hi active traders, I'm Ken Calhoun. How many times have you been frustrated that you're almost there, you feel like you're just on the edge of achieving a breakthrough as a trader, but then you get stopped out in your trade yet again? It can be frustrating. As you go through a series of small wins and bigger stop losses, you realize something has to change. In this episode, we're going to look at 3 success strategies that may help you start turning the corner carefully in your active trading. Coming right up. Strategy number 1 is to start trading wide, meaning more instruments, instead of deep, meaning just 1 or 2 with a magic chart pattern or a special signal that you got from some vendor somewhere. What I found makes a big difference is it's a numbers game. There's no silver bullets. It's all about throwing a lot of darts at the market, scaling into the ones that work out, and taking really tight or break-even stops for the ones that don't. So by trading wide, I use what I call pilot trades. You may have seen a video that was recorded many years ago at one of my Money Show appearances where I was talking about small size trades that you then build into. Pay special attention to the ones that are making money for you. When it comes to confidence, that can be one of the biggest game changers. It was for me, because I really don't sweat it if it's a small size trade, 10, 20, 30, 40, 50 shares instead of 300 or 500 or 1,000 shares, or a stock or ETF trade. So trade maybe a dozen different instruments on small size like a portfolio manager, and then start building, adding shares to the positions that work out over time, and scaling out of or stopping out of the ones that go down or go sideways. So trade wide, not deep. It makes a big difference because it helps you sleep better at night, especially if you're in, say, a dozen different instruments, small size. You don't worry about how any 1 or 2 or 3 of them are going to work out. Instead, what you worry about or concern yourself with is the total aggregate performance of the entire basket of instruments. That's a good professional trader's tip, and I think it can really help you. The second tip is to know your trading patterns, the chart patterns, by memory cold, whether you're using candlesticks or Western technical breakouts, or preferably a combination of both. With your candlestick patterns, you should at least know your hammers, your shooting stars, your bullish and bearish engulfing patterns, and your doji. With the Western technical charts, make sure that you understand the nuances of things like ascending triangle breakouts, cup pattern breakouts, what I call acceleration breakout trends, where over time the momentum gets sharper and steeper up to a nice 45-degree angle breakout. Or my favorite, which is gap continuations, minor up to 10% gap continuations. But the better you learn your patterns and the more time you spend focusing on those, the better you are to achieve mastery as a trader. It's all in the nuances. The challenge with classic chart patterns, and you may have experienced this yourself in your own trades, is that oftentimes it looks great on paper, but in real money trades you get stopped out by false breakouts. So instead of buying right above resistance as something pokes its head above the obvious resistance level, say on an ascending triangle or a pennant or a cup pattern, give it a safety buffer. For swing trades, I like 50 cents or so above the previous high. For day trades, at least 20 cents. Use a false breakout filter to keep you out of bad entries, and make sure that you spend a little more time mastering at least 2 or 3 chart patterns that are your go-to patterns as a trader. Your success as a trader is based not on your understanding of basic chart patterns, because those generally don't work. It's the nuances of the chart patterns. And again, keep it simple. Don't focus too much on overcomplicating with many different derivative technical oscillators and all the rest of it. Simple, strong price action breakouts are really what you want to focus on as a trader. So that's the second success secret, is spend more time on mastering at least 2 or 3 chart patterns that are personal favorites, like mine are gap continuations or cup patterns or ascending triangles or others. And our third tip of the day is to make sure that you've got a process in place. And by that I mean a flowchart. You may have downloaded one of my PDF flowcharts before. A step-by-step sequential process that helps you scan for good candidates, set your initial entries, set your stop once you get filled, scale out once it starts to fade back down, scale in if it keeps going up, and understanding the difference between which steps are going to lead you in trouble versus into a successful winning trade. And what I mean by that is it builds comfort and expertise to know how to do something like it's a routine, step by step. You know, in the morning you get up, you go to the bathroom, shower and shave, get some breakfast, put on clothes, go to work. That is a process or a routine that is comfortable and it works. Similarly, as an active trader, it really makes a lot of sense for you to develop a step-by-step process. What I like to do, I advocate for traders, is to map out a top-level flow chart of 5 to 6 major steps, like scanning, setting your initial stop, scaling in for the winners, scaling out for the ones that aren't winners, doing scanning with sectors, understanding the difference between strong versus weak markets, and being able to develop a robust step-by-step strategy. And that process, and one of the key goals is to keep you out of trouble. So having discipline. Example, for years I'd always have a small post-it on the edge of one of my monitors saying, keep small stops, less than 50 cents 100% of the time, right, for intraday trades, or 40 cents, or whatever I was trading. For swing trades, no more than a 2-day low and you're out. So a process should have reminders visually around your workspace to help you stay on top of your rules as a trader. And I know everybody talks about having a trading journal and writing down things. When was the last time you looked at yours? That's what I thought. If it's out of sight, it's out of mind. So trading journal, it's nice in theory, but in practice, what I like to do is have a visual trading reminders. Instead of a journal where I've got things off in some Excel spreadsheet or a notepad or something, I like to have visual reminders around my workspace, whether it's little shipping labels or post-it notes that have rules, or printouts of charts on the wall that have rules identified with the Sharpie marker. Visual patterns can really help you improve your trading as well. So those kind of things go into what I'm talking about when I mean process. Your process as a trader is designed to serve you well. Number 1, to keep you out of big stops, and number 2, to keep you in on profitable trades. And understanding the difference between the two is where your success as a trader really comes to life. Well, thanks so much. I hope this has been helpful. Until next time, I'm Ken Calhoun, TradeMastery.com. Trade with passion, trade with really small stops, and try to take as much money out of the markets as you can. Best wishes for successful active trading. Goodbye.